you can't you can't build it for what current rents are and current construction costs are and make any return. So we feel very insulated from that, except for at some point the demand will get to the point where there will have to be new product built. And when they do, they'll command higher rents, and that'll just help us continue our process of moving rents higher. So, we're buying these at currently our current portfolio plus what we have under contract, all averages out to about $93 a square foot. We've gone through the process of bidding and trying to look at a development program, and the numbers come out to be more like $140, $150 a square foot.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Jeremy Friedman. Jeremy is with Stoic Equity Partners, and they have a portfolio of 10 self-storage flex industrial assets in the Southeast, totaling 48.8 million assets under management and 500,000 square feet, located in Georgia, Mississippi, Florida, Alabama, and Arkansas. And in just a minute, we're going to speak with Jeremy Friedman about why invest in flex industrial real estate. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Jeremy Friedman. Welcome to CREPN Radio.
Thank you, Darren. It's great to be here. Appreciate you having me on today.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
So I am the CEO and co-founder of Stoic Equity Partners. We are a private equity real estate company based in Alabama that is specializes in investing in flex industrial assets around the Southeast. Prior to my time with Stoic, I was a commercial real estate broker at my own firm and still am, though that's takes very little of my time these days, but Catapult Properties. And before that, with a regional firm here in Alabama, specializing in single tenant net lease retail properties is what my brokerage experience, my main brokerage experience. Prior to that, I worked for a commercial real estate developer, developing single tenant net lease retail properties. So I worked with him on dispositions. So assets such as AutoZone, O'Reilly Auto Parts, Dollar General, CVS, Walgreens, most fast foods, all of those type of assets. So that's what got me started in commercial real estate. Before that, I was a contractor, home builder. And before that, I was an investment banker. I sold institutional bonds for a firm in Memphis, Tennessee. So kind of all three of those roll together now to make a pretty good base of knowledge for private equity real estate.
No, that's great. definitely sounds like a solid base for the financial and the construction and the real estate aspect of things. That seems like a pretty solid base.
Yeah.
So your your firm, excuse me, Stoic Equity Partners. Um, how did you how did you guys come together, and how did you arrive, given your background with the single net retail space? How did you arrive at flex industrial space?
Great question. So, Stoic, we came together, my partner Grant Reeves and I came together in 2020. Grant and I had worked together. He was also a commercial real estate broker at the regional firm I worked at here in Alabama before I branched out on my own. He went on to work at Marcus and Millichap in their hospitality division. We came together in 2020 with the vision and had always discussed trying to move over to the principal side of things rather than the brokerage side of things. So with COVID, the phone stopped ringing just long enough for us to hatch the plan for Stoic. And we originally started with self storage. Our first four assets were climate control self storage facilities. We have one that we did an adaptive reuse of a grocery store anchor box, and we bought a very stabilized asset. We bought one that in Little Rock that we expanded significantly, and then we did a ground up construction project. Was the last self storage facility that we did. We started having issues making numbers work, and especially with rising interest rates. There were other asset classes we were very interested in. One of them being multi-tenant value add flex industrial, which we had a very significant interest in this asset class because especially here in the Southeast where we have rising population, and then there's a very fixed amount of supply of these flex industrial assets. So the supply and demand dynamics of that asset class is in our opinion, unlike any other currently in the commercial real estate world. If you think about all other asset classes, multifamily, retail, self-storage, office, supply has increased, traditional office, supply has increased in many of those cases significantly over the past 2 or 3 decades. And even Class A bulk industrial properties have increased supply tremendously over the past couple of decades. However, these multi-tenant flex industrial properties the supply has actually shrunk over the past 30 years. And so you've got that coupled with increased demand, and you have a perfect formula, in our opinion, for being able to add value to these properties. So kind of the first question out there, I think, is on a lot of people's minds typically is what is flex industrial real estate? It goes by many different names, I guess. But, office warehouse complexes or shallow bay industrial. But, we like to call it the mullet of commercial real estate. So in the front, you've got nice storefronts, offices, and showrooms, and in the back you've got dock highs and roll up doors and truck courts. So it's kind of business up front, party in the back. And so that's kind of took real quick. Everybody knows what this is, but maybe flex industrial is not a terminology that your listeners are used to hearing. But
No, I appreciate you going. That's exactly where I was getting ready to ask you if you could define it for the listeners. And I'm also kind of curious the type of property you described, with the storefront in front and the kind of the warehouse or the space in the back that can be used for, whether, I've seen all sorts of different types of operations in the back, but nonetheless, is there any kind of a definitive or I guess a definition, or is there a range of possibilities? Because I also see or I've seen, and tell me if this is true in what you see as well, that like a degree of flex space from, because I've seen some that are hard to tell the difference between like a self-storage, just from a standpoint of they're just kind of all one story, same type of occupants like we were just talking about, but the construction seems very similar, other than the fact that the space is probably larger than a self-storage. Do you see that as well, or is that?
Yeah, so I don't know that this is any defined terminology, but we kind of would call that a contractor garage. So those tend to be steel buildings, front load, so both your roll-up door and your personnel door are on the front. Typically, it's just a personnel door into maybe a one room office and a bathroom kind of thing. And there's plenty of demand for that type product out there. And I see a lot of landscapers and painters and those
And
types.
lots of trades. Yeah.
Lots of trades needing
Yeah.
that, and I think that there's a lot of room in the market for that. Typically, the properties we're buying though are a little different. Sometimes they're still building construction, but maybe a little dressed up facade, more of a storefront on the front, and then the truck court or roll up doors are in the rear. Some of ours are masonry construction. Some of them are tilt wall concrete construction. So a little bit nicer. And what you find in those are more service based organizations like HVAC contractors, which is or Terminex, or an engineering firm that needs some office space up front, but they also need some warehouse or some lab space in the back. So those are the type of users we typically have. Our facilities, some of them have suites as small as 1,200, 1,500 square feet, but for the most part, they kind of range more in that 3 to 10,000 square feet. So we'll see also some last mile logistics companies, a FedEx or JB Hunt, somebody that has they're doing last mile logistics. We have several pharmacies in our units because the front of the buildings are dressed up. Believe it or not, we have several salons in our buildings. They're very flexible, i.e., the flex industrial, right? But typically what we're doing is we're buying these things below replacement costs from legacy owners that are maybe they have a lot of sunk cost and some heavy office build out from say the early 2000s when office was they needed more office space. And we're going in and we're actually in a lot of cases ripping out a good portion of that office to get it back to say a 50-50 or even less office split on a flex property. A lot of these legacy owners are not doing a very good job of deferred maintenance and repairs at the facility. So we're able to go in and, fix some facade issues, repaint, reseal and stripe the parking lot. Occasionally we have to put new roofs on these things, but we go in there and we kind of right the ship. We're able to start commanding higher rents. And we're able to secure a higher grade of tenant and higher rents and get increased occupancy. The demand is there, but what we see is a lot of times you'll have an owner. We have one facility in Little Rock, Arkansas. We purchased from an owner. She inherited the building. She was in California. She inherited the building when her husband passed, and had never seen the property, never wanted to use any of the cash flow to do any maintenance, which was kind of didn't make much sense to me because it's all passed through in CAM to the triple net tenants, and never pushed anybody's rent. So we bought that property with some $4 and $5 rents in there, and we're currently getting $8.50 rent on it. So still very low rent, which is another thing we like about the product type. You can't you can't build it for what current rents are and current construction costs are and make any return. So we feel very insulated from that, except for at some point the demand will get to the point where there will have to be new product built. And when they do, they'll command higher rents, and that'll just help us continue our process of moving rents higher. So, we're buying these at currently our current portfolio plus what we have under contract, all averages out to about $93 a square foot. We've gone through the process of bidding and trying to look at a development program, and the numbers come out to be more like $140, $150 a square foot. And so, we have 100,000 square foot facility in the Atlanta suburb under contract at $64 a square foot. You're talking about significantly below replacement cost. And so we just feel like all those dynamics line up to be a really strong asset class moving forward for the long term. We also see the fact that occupancy in a lot of these, though they were affected by COVID, just were not affected to the degree of traditional office, because if you need a warehouse as part of your operation, you're not going to go work from your spare bedroom at home. So those are kind of all of the reasons we love it, and the types of assets we're talking about, and the types of tenants we're talking about.
Yeah, it doesn't sound like you're very enthusiastic about it at all.
I appreciate you letting me talk about it. It's my favorite subject.
No. I'm like just like beaming, just like listening and hearing what you're saying and kind of nod along. I love the first thing you said about buying below replacement cost. Because I think that was always something that stuck with me. I remember reading something Sam Zell wrote, just kind of as a basis of whatever you're investing in. If you can buy it for less than you can build it, you've got equity. And then the other thing, it sounds like between deferred maintenance and just kind of tired owners, you've got plenty of room to improve the property, and then also improve the rents, whether it be through expiring leases or vacancies and new tenants. And like you said, the demand, that seems like a recipe for a win, if you have more demand than supply. And like you said, the other asset classes, office is like upside down right now based on just everything's about ready to happen. Multifamily, there's clearly demand, but it seems like there's in lots of pockets, there's been tons of supply. And even like you'd mentioned in some of the self-storage, I'm seeing some of that as well. But so let me ask you, so the size of properties that you guys are investing in, give me kind of a range of square footage, park size, or what are we talking about?
So, our fund, the box we defined for our fund is a minimum of 20,000 square foot. However, the sweet spot for us is in that 50 to 100,000 square foot range. And typically that's a multiple building complex. And it really tends to work well from a size to manage, to offer leasing, and deploy capital. It's a lot cheaper and easier to deploy capital per capita, so to speak, on a larger deal. If we were going to go, and we have done deals 20,000 and up from there, but those are typically to fill into a market where we already have a presence. And so really that 50 to 100,000 square feet range is our ideal. I will say that currently under contract, we have 3 assets. One is just under 100,000 square feet. That's in the Atlanta MSA. One's 128,000 square feet in Louisville, Kentucky, so a little bit larger, and then one's 158,000 square feet in the Jackson, Mississippi MSA. So those are on the larger side of our target range. But they all are excellent assets. We're very excited about them.
So as far as the I guess probably the budget for capital improvements, when you acquire something, is there like an immediate, you talked about, parking lot and tearing out some of the space that maybe is no longer in use or needed. Is there kind of a uh, is it more like curb appeal that's needed, or is there actual like structural? You mentioned, I guess, a roof that you may have had to replace, but do you find that most of this is when it? I guess what I'm trying to get a feel for is like we're not talking about kitchens and bathrooms like in a multifamily. What give me an idea of what you would expect on a property you're going to acquire, what you would have to do from a capital improvement standpoint.
And it's very deal by deal. The asset in Jackson, Mississippi, it's actually a portfolio of 4 buildings that I just mentioned we're under contract for. It's 158,000 square feet. It's currently owned and managed and operated by a REIT, and it's very well maintained. The roofs are all within 5 years. The parking lot's recently sealed and striped. There is really almost no capital expenditures needed day one. However, then you take the flip side, you take, the absentee owner who owns a legacy asset for a long time and is not really on top of managing it and not willing to spend. And then there tends to be a pretty large budget. So what we do is during our underwriting process, before we make an offer, we try to come up with what we anticipate those expenses will be. Once we're under contract and doing our due diligence, we refine that through actual bidding processes with contractors. But we will set all of that money aside up front. We'll also typically set at least the first few years worth of tenant improvement and leasing commission budgets up front into reserves. We'll reserve annually. We'll be reserving for additional capital expenses and insurance and taxes along the way. So our model takes all that into account up front. We don't, if we say, for instance, buy a very heavy lift value add property, that cash flow is very low on the front end because we're assuming some, legacy, very low rent leases, and it's going to take some time. We'll also reserve some debt service and carry costs up front to make sure that we've got all the budget needed. But we've replaced roofs, we've done parking lots, we've had to repair stucco and redo that, and all that's kind of, like you said, cosmetic. Obviously, roofs are not cosmetic, but a lot of that stuff is cosmetic. And then we also kind of take into account, these are our vacancies. What needs to be done on these vacancies to get them market ready? And a lot of times that is tearing out some of the older office build out and freshening up the rest of the office space and cleaning it up and that kind of thing. So we'll kind of do all that on the front end and figure out what we need. So, but it's a pretty broad range. You've got some owners that are neglectful and some owners that are on top of it. So,
right. So when you are acquiring properties, how are you finding these? Are these broker represented, or are you guys going direct to the seller? What's your strategy there?
So great question. Grant and I both came from the brokerage community and value brokers. We also are casting a pretty big net across what we call the SEC region, so across the southeastern U.S. We are building a broker network. So we're buying these in these, secondary, probably tertiary cities, or probably technically tertiary cities around the Southeast that are 500,000 to 1.5 million population. And usually in each market, there's one or two brokers that are very active in this asset, from a leasing, sales, and management standpoint. And we will identify who in that market is very active in the assets we want to play with in that market, and we will engage them, build a relationship with them. We will database the market and give them, literally hand them a list and say, we will buy these assets if we can agree to a price with the seller. Those brokers have relationships with these owners already. They've placed tenants, maybe sold them the property to begin with. So it saves us a lot of legwork and time trying to build a relationship with some guy or girl that has, owns this property that gets 100 calls a month and just hangs up. And we get a chance to build a relationship, explain who we are to the broker, let them go and utilize their relationships that they've built and the trust that they've built in that market to help us find assets. And so what we find, what most of the properties we buy are off market, but brought to us by our broker network. And we, we value that. And then typically they're going to be our leasing agents for that property once that we purchase it, and they're most likely going to be our management company. So we use third party boots on the ground property management in each market. It was very important. Market knowledge and boots on the ground is all very important. We have an asset management team internally that manage those managers. And we have a couple of staff accountants in-house. We've got an asset manager, myself and Grant, that all handle the asset management of these. So that relationship with those in-market brokers has been invaluable. They know where the skeletons are buried. They know what tenants are out looking for what. They know who to avoid, what to avoid, and what's coming down the pike. We get a lot of times we get market information in these remote markets before a lot of the people in the market do. So we really value that relationship.
No, I love the strategy. I mean, especially being a broker like you are, having the relationship with the brokers and being able to come to them with kind of a list of these are target properties we'd love to acquire if we could get, agree on a price and establish yourself. That's great. When you are acquiring these properties, we talked about the size of the property and even like the dollar per square foot, but I'm just kind of curious what on a price, or maybe we talked about square footage. What kind of a price range are you seeing for, what's within your ability to take down a property as far as deal size?
So we're currently doing deals in the $5 to $15 million range.
Okay.
So when I say 15, that usually would include all of those reserves and all of the full investment, not just the purchase price. So there again, you take a 150,000 square foot deal at $90 a square foot. You're a $14 million property basically.
Right. And let's talk a little bit about the capital stack. You've got your fund. What are let's talk about, I guess, the investors. What's the appetite for investors investing in your fund? Are there more wanting in, or has it been a struggle to raise capital?
I would love to say that we just have more capital than we can deploy, but it has. This is our first fund. The first 10 assets that we acquired were all syndicated, and we needed to make the move to a fund for multiple reasons, but mainly to get out of the syndication of a certain size deal that we were comfortable raising the money with friends and family and friends of friends and friends of family, our existing network, our existing Rolodex, and move to a situation where we had the ability to talk to more people and grow that Rolodex, right? So anyway, this is our first fund, $25 million worth of equities, our target raise. We're right at 8 million right now in the actual fund. But let's talk about the capital stack a little bit. So in each, so we are using a variety of debt. We have bank debt. We're assuming a CMBS loan on one of our deals at a 4.85 interest rate. So we like that. And we're originating a life insurance company deal at the moment. So at a 5.85 rate. So we're really excited about that debt. Obviously CMBS and Lifeco doesn't really have an appetite for a heavy value add lift, and those we go to the banks. So that's our debt. We always fix the rate. We're doing a 5-year term. Our fund is 5 years. So we fix the rate for a 5-year term. We then are taking a mix. Sometimes we will bring in a joint venture equity partner at that asset, at each asset level, and the fund is co-investing with them pari passu for that asset. So we do have a blend of our fund and other single large check writers that for each asset. But the fund has an interest in all of the assets moving forward. The first 10 properties, they're all done deals, they're syndicated, they're not going into the fund. But all these new assets moving forward, the fund has an interest and a managing interest in all of those assets.
Got it. You mentioned a couple of the interest rates and some of the terms, 5 years. Are they, how long are the amortization schedules for the loans? Are they 25 or?
We're getting 25 mostly, yes.
And then what's the leverage percentage? Are you able to get 70, 75 or on?
No, 70 is the highest that
70.
we're doing at the moment. So we've got one that's 60. The Lifeco deal's at 60. The CMBS that we're assuming is in the low 50s. I think it's 53%. And then, but 70 is where we're typically landing.
No, that all seems reasonable. I know, in recent past, everybody was all excited about more leverage, more leverage, more leverage. But as the rates change and those deals, expire and you have to refi, I think having a lower leverage makes a whole lot of sense.
It helps us sleep a little better at night.
Yeah.
And
Yeah.
so
that makes sense. I'm just trying to think, looking down my list. It's funny because I had kind of had a little list of questions, and as you were talking, each time you say the next thing, you'd like answer, how you're doing, your value add, your boots on the ground, and your, third party management. You got people on the ground, and how you're acquiring properties. But primarily, just to summarize here, you guys are buying existing stock. You're not, it sounds like you've had experience in some construction, but that's not really anything you're looking to do just based on the cost. Is that?
Yeah, we developed one self-storage facility from the ground up, and then we tripled the size of one facility. And we continue to have an eye towards development when it makes sense, but we can't seem to make sense of it at the moment. So most of all of our construction and project management at the moment is directed towards renovation work, these new acquisitions, and tenant improvement build outs and things like that. So, we would like to, we see the need in some of these markets, and there are a couple that rents are getting close to being in the range that they could start to support some new development, but we haven't seen the right opportunity to jump out there and develop. But that is something that it's, I won't rule it out. Again, back to my investment background as an institutional bond broker, a lot of what I did was work with banks and insurance companies to manage their bond portfolio. And we kind of look at real estate similarly. When the opportunity is there, it's time to invest in different asset classes or different phases of the asset classes. Right now, the market is giving us value add multi-tenant flex, and we're all in. So, I mean, it's that window may close, or that opportunity more people may come into it, or whatever. But at the moment, that is such a strong thesis, and we're having strong success with the properties we own. That's where we're focused at the moment.
No, I love it. Jeremy, if we could, I'd like to shift gears here for a second. As I mentioned to you before we started recording, by day I'm an insurance broker. And as such, I work with my clients to assess and determine what to do with the risk that they face. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize, we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can take a look at their own situation. Could be your investors, the interest rates, the brokers, the local municipalities, global, whatever might be the case, but whatever that you identify and what you consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And
but as we discussed before the call, that's actually the one largest risk item that does keep us up at night, and that we're working diligently on at the moment is our insurance. And I think so this is not, to be clear to your listeners, you did not prompt me for that at all. This is our biggest risk at the moment as we see it. We, being located on the coast, the Gulf Coast of Alabama, and we have several coastal properties in Pensacola, Florida, Baldwin County, Alabama. We are being hit with tremendous increases in all of our property insurance, especially in the wind policies. And they're becoming increasingly hard to get. And to give you give your listeners a couple of examples, we have a property in Pensacola, Florida. We put it under contract. The insurance was, and this was under contract in 2022. The insurance policy was $27,000 a year. By the time we closed on it in early 23, the policy had renewed to $47,000 from $27,000. However, we needed a new policy, and the same carrier, and I will not name names, but the same carrier quoted us a new policy 1 month after they just renewed for $47,000 at $72,000. I just yesterday got a quote for this year's renewal, and it will go to just under 6 figures. It's $99,000. So from 27, so quadrupling in 2 years, essentially. Now, the problem at that facility is we have gross leases at that facility. Now, we have been very successful at getting the tenants to renew at significantly higher lease rates. And all we have to do is say, hey guys, y'all know what's going on with insurance, property taxes, and expenses. This is the new rate. And they've all signed it. And so we've luckily been able to mitigate that. All of our self-storage facilities are gross rents, of course. So these higher operating expenses are a drag to NOI. A lot of our facilities, thankfully, are net leases. However, um, there's a limit to the total rents that these tenants can pay, right? So if the CAM charges increase significantly, that lowers what we can get out of them for rent, or what we can attract new tenants for rent. So we consider this an extreme risk of our industry nationwide in all aspects of real estate, commercial real estate. So this is what keeps us up at night. We work with a large broker, an international broker who carries a pretty big stick, but we're still having a very hard time controlling these costs. We're working on putting together some master plans. We are exploring a captive policy that we can bring in house and manage ourselves to try to reduce the expense, and potentially be able to save money and or be able to refund money back to those certain assets after a period of time. We see the risk as twofold. One is rate. So all of the insurers have increased their rate tremendously, but we also see it on the replacement cost side, the total insured value of these properties, because we buy it at one price, and as you know, I mean, we are well aware we're buying it below replacement cost, but we get in arguments all the time about what is replacement cost with our insurers. And of course, with co-insurance, we can't be underinsured, or else that leaves us very, very vulnerable in the long run. So, you know, uh, we don't see replacement costs or construction costs coming down anytime soon. You know, so that part of the insurance premium, I think, is we're probably all going to have to stomach. Hopefully, though, we can get some more competition back in these cat markets and these higher risk markets to be able to bring the rates back down. But I think it, uh, I think though, with the replacement costs where they are, truly where they are, and where they probably will remain, it's going to be hard to get any real relief here for a while. And I think it's all going to have to transfer through eventually to the tenants, and it's all going to continue to keep rolling downhill to the consumers. And so, I mean, I think we see inflation continuing for many years. We don't see it under control by any means, and which is also why we like multi-tenant value-add flex industrial properties where we can continue to push rents. So that's a long story to say insurance keeps me up at night, and how we think about it and what we're trying to do to help mitigate that risk.
Well, I'm impressed. I'm sad and I'm impressed. I'm sad that you know that much about insurance.
I did not
Yeah.
until this happened.
No, but I mean that's basically, I felt like I was getting some continuing education there just based on your knowledge of it. And it's a very, very frustrating thing, and I can only tell you the broker dealing those, or delivering those messages, it's not easy right now. It's you're kind of stuck. I mean, because there's not a lot of options out there, and the options that are available are not they're not conducive to making your NOI improve. And it's a frustrating thing. But like we discussed before we started recording, these are cyclical, and as you mentioned, as these carriers their profits improve, more carriers will come to the market, and there'll be some sort of a normalization. The hope is it's sooner rather than later, and so everybody can kind of get on with it rather than worrying about the insurance. But I appreciate
I
you.
have two more insurance related
Sure.
items to bring up.
Sure.
One is we are increasingly understanding that a lot of these insurers are baking in some climate change into their models and their risk models. And I think that that's driving rate a little bit. And so hopefully, you know, like we mentioned before the show, we saw this here on the Gulf Coast after Katrina. We saw a lot of the same things, a lot of carriers pulling out, the new carriers coming in at very high rates, and then eventually the phase of this that was helpful was once there were a few years without any major storms and the carriers that were in the market made some good profits, then other competition coming in. So hopefully what I'm going with that is hopefully we do see a few years without major catastrophes. But it's it's more of a global issue on catastrophes, I think, than it is locally. Because again, it's the reinsurers who are driving a lot of that rate, and they're having to pay out on worldwide catastrophes. So it's no longer just the storm here in the Gulf that we're really concerned about. We had a great storm year last year, but it didn't really help because there's fires and floods and everything else going on around the world. But we're hoping that some of that stuff will settle down. But something that is a pet peeve of mine is the very first thing every carrier does is give us a notice of non-renewal. And then they say, okay, now we'll quote you a policy. Um, and maybe you can shed some more light on this, but and no offense to brokers, but at all, but brokers make a higher percentage commission on that first year policy than on renewals. So all it does is ended up driving up that premium again.
Yeah, I don't, so let me give you kind of the skinny on that. So the
Yeah,
notice
please.
is not from the broker, it's from the carrier. And the
Right.
carrier is following, more often than not, it's the legal requirements, because there's two things that I'm aware of. One is if the rate of increase is above a certain percentage, they have to give you notice that the rate's going to be above. And I can't even remember what it was. It used to be like 25% or whatever. If it's going to be more than that, they had to let you know. The other is, given the market and their capital stack, whether it's their reinsurance or whoever is behind them, or their capacity, um, they're putting you on notice that they are not inclined to offer renewal, and that's to fulfill that legal requirement. Because if I've had it happen, like with earthquake. You've got a carrier that's they've written all they can in a particular market, and even though you were in line, they bound more than they could handle before it was your turn. And so that's kind of an issue. As far as and again, provided everything, they want to continue with you, and they will, but it's more about so they don't get brought up before the insurance commissioner, that they didn't give you notice. And that's literally what it is. It's not about they don't want to continue. It's more about kind of dotting the I and crossing the T, and kind of CYA, so they don't get a fine or in trouble with the insurance commissioner. And as far as the making more the first year versus the second year, I don't. That's kind of a life insurance model. That's not a property and casualty model. The P&C market, it's the percentage based on the premium written premium period.
Okay.
So there's
That
not.
makes me feel a little better that,
Yeah. Because that
every time I get one of these non-renewal notices.
yeah, a life insurance policy totally. I'm licensed for life, but I can't tell you. I mean, I think I've bought more life policies than I've sold, and the but the commission's weighted heavy on the first year, as opposed to the trailing years, and so kind of a different commission model. But again, I'm saddened that you know so much about insurance, not because you're an educated consumer, but just the fact that the market is what it is that causes or requires you be so knowledgeable about it. And I'm hopeful that this too will pass in a short amount of time to where you can get more focused on finding more deals and doing more deals and making more money for your investors.
The bright side or the silver lining is that we always think of is, hey, if we can make deals work today with interest rates moving up in our face, with insurance rates where they are, we feel really confident about the long-term performance of all those assets. So that's the silver lining.
And
That's,
really
that's
is
our stoic attitude about it, right?
well, and it'll prove true. If you can make it in this market, you're going to be fine.
Yeah.
So anyway, well, Jeremy Friedman, I have enjoyed this immensely. And let me ask you this: where can the listeners go if they would like to learn more or connect with you?
Yes, thank you. And I've really enjoyed being on. It's all. I mean, I'm a real estate nerd, so I just love talking about it, and I appreciate any chance and opportunity to talk about it. Our website is probably the fastest way to get information and get to us, and that is stoicep.com. So STOIC EP, that stands for Equity Partners.com. All my contact information is there on cell phone. I'm fairly active on LinkedIn if they want to reach out or find me there. But on the website, there's a couple of links to fill out to get more information about the fund. We are currently in an active raise and deployment period. Minimum check size $50,000, so it's pretty approachable. And that's probably the easiest ways to reach me. I will, again, love talking about real estate, so hopefully anybody can reach out and reach me. So
awesome. Well, Jeremy Friedman, I can't say thanks enough for taking the time to talk. Again, I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you, Darren. I really enjoyed it. Look forward to talking to you soon.
All right. Okay. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.